Bill Baruch, president of Blue Line Futures, is back to give us an update on his market overview and why markets are behaving the way they are right now. Bill, welcome back.
Thank you for having me on again. Really glad to join you.
Really glad to have you back. And it's always an interesting time whenever you're back. I don't know if we don't purposely time it this way, but the markets are always just doing something funny whenever you're on the show. Right now, the funny business to me, at least, is this week, a bunch of positive economic data has come out. Retail sales, PPI. So as you know, retail sales up 5.3% in January, yet everything seems to be down. Gold is down, equities are down. I'm looking at the dollar, the DXY is down. The only thing that's up is yields. What's going on?
And we've been calling for this. I've been talking about this story going back to at the end of September, early October, when the 10-year yield was at 60 basis points, saying our trade is getting short treasuries and looking for 1.25. And really, the 1.25 is the resistance, and we're trying to chew through that. Our fear was the sort of get through that resistance in a quick move to 1.5%. Now, when the treasury yields rise in the certain landscape that we're seeing right now, and they do it slow and steady, it's not a big deal. But if we see big 10 basis point, 20 basis points, even 30 basis points in a week or two, that starts to hit a pain threshold. And we've been looking at the fact that 125 is resistance in the yields, and you're seeing about 136 or so in support. 136 points support in the 10-year futures. Once we kind of break down through there, and this, you can see a quick move up to 1.5 is exactly what the market is fearing right now. And that's why we're seeing, some risk assets start to come in a bit.
Why is 1.5 the pain threshold? What does that term mean?
You have a lot of debt printed. You have a lot of debt on balance sheets, and it's going to cost more to service that debt. So with 1.25, it's sort of a move that was still staying contained within the range that we've seen going back to March of last year. But when we start to see it move outside of that, you're getting a more of a fast, velocity is really the matter here, and it's a fast move is what the market's fearing. So if we've got 1.25 and then we slowly grind up over the next couple of months to 1.5, it's not the same thing as seeing that 25 basis point move in say a week or two.
Yeah, I remember you were on the show a couple of months ago and you were calling for higher yields. At the time, that was still a contrarian call because most people were expecting yields to remain flat, if not trend lower in terms of negative yields. But what we've seen is negative real yields have stayed flat, hovering around negative 1%, and nominal yields have gone up. Why have nominal yields risen, Bill? That's my question.
We're starting to see a little bit of economic rebound, but just on the activity side, and all the stimulus is working out there. And then not only that, though, we're seeing the market planning for that added supply from fiscal policy. They got to print more treasuries. It's adding to the supply in order to cover that debt that's they're putting through and passing. So it forces the yields higher as the prices go lower. So I think there's a number of things here. As we look through an economic rebound, some of the data has been good, but obviously good from low levels. But it's definitely a light at the end of the tunnel, and then you get all this inflation from that stimulus itself that's out there. And look at energy prices and the cost of lumber. Inflation is real, even though we didn't see it in CPI last week.
Yeah. So let's talk about market reaction then. Wouldn't you normally expect the markets, at least the equities markets, to respond positively to good economic news? So retail sales are up. Inflation, PPI data has risen in January. The savings rate has gone down, so that could be good or bad depending on how you interpret it. But economists are predicting higher consumer spending in 2021. Equities are still lagging. Why?
Well, that's exactly what we're seeing here. I think it's relating to the yields, but also the other side of the story is, a little tailwind. And one of the tailwinds we saw a few weeks back was when two Fed governors, Bostic and Barkin, they had spoken about potentially having to unwind some of these measures, policy measures towards the end of the year, turn of the year. And that was really, they called it an educational discussion, not a real plan. And then that's where the yields backed off pretty big. But that's what we're seeing. You get this economic activity out there, you get inflation out there, then there obviously is some fear that the Fed is going to have to rein in some of these extravagant and unprecedented policy measures. Mm-hmm. But, they have been reiterating that they're going to stay accommodative until the jobs picture gets better. And Fed Chair Powell said, the real unemployment rate is closer to 10%. So just here Thursday, the initial claims were much higher than expected. Non-farm payroll 2 weeks ago, much worse than expected, and it's been a pretty bad jobs landscape, and that's what's going to keep the Fed accommodative. But they can't ignore the fact that economic activity is picking up a little bit, and so you get a bunch of crosswinds here.
I don't understand why yields are up, but the dollar hasn't risen proportionally. It's still kind of flat, actually down from the month. I'm looking at the DXY index. Wouldn't you expect the dollar to rise in this circumstance?
Well, the dollar has been very heavy, through the part of last year, most of last year, and I think that has a lot to do with it. There's obviously still a lot being printed, and there's a lot coming down the pipeline. So I think that's hurt the dollar to a very large degree, and we've also seen some talks of just mirroring out of the ECB, mirroring what you've heard here in the U.S. When are they going to have to unwind some of the different measures? Not that they're planning on doing it. So, I mean, you get again, what is the dollar being relative to, and if you're comparing it to the euro, if you're comparing it to the Chinese yuan, that's I guess really matters the most. I do expect the dollar to be more sideways to down, and I think this recovery in the dollar is going to give a pretty good opportunity to fade.
Okay.
But again, it matters what currency you're looking at it against.
So let's put this together for certain assets now, starting with gold. So we've got the dollar trading sideways to down. You've got yields going up. You've got a real rate staying around -1, not really going down where it could be positive for gold. So what does this mean for the yellow metal? Does it trade sideways from here? Does it go back up?
I mean, that was one of the things, one of the trades we've had was being short the treasury prices and coupling with that with any long gold exposure. So we're basically hedging out. And then we were looking at platinum and silver as beating gold to the, this year. And so I think that was sort of the trade that we've had. And we haven't fully hit the 10-year downside in prices that we've expected, but we've already started to taper out that position, sort of thread the needle, if you will, as gold is also hit into a big level of support. It's a battle here, and we put out research each day, and this 1770 area is what we call rare major 4-star support. So a big battle going on here, and I think the fact that we did see a good spike in the treasury yields this week and from last week, that has encouraged a bit of a bit of caution in the equity markets, and then on the technical side of those equity markets too, you had the big move higher to record highs through the holiday, and then they came off. So you get a big reversal, and then if you get a weekly reversal wick like that, that is doesn't look good. I'm not calling for massive correction, but I think another healthy pullback. We chop around the same way we had the late January pullback. We chop around similar to we did through September and November of last year. So when that happens, then that's going to buoy the treasury prices and pare back those yields. So that is what could bring some strength to gold. We start to see the dollar sort of at least just sideways, right. Dollar not gain much, but the treasury prices bounce and gold bounces along with them and gold gets those safe haven attributes, which is what we're looking for right now.
Yeah, that was my next question, yield. So where do you anticipate yields to go from here? The yield curve has steepened a lot since actually 2020. It's continued to steepen. Can you see this trend continuing where it can start flattening? What do you think is going to happen?
Well, I've called this intermission. I've called this intermission in the move of yields to coming up. I mean, I've been pounding the table for years that yields are lower for longer. Is this a bigger, more of a historic move? I mean, I don't think so. I don't think this is a bottom in the yields. I do think this is, and that's one of the reasons why we looking at 1.5%, because you get that blow off between 1.25 to 1.5, and that would actually give a good opportunity to then buy treasuries. We're already seeing the 30-year bond well out above 2% right now. I mean, by 10 basis points or so, and that's again, you're talking a steepening curve, and that steepening curve is is, why are equity markets record highs? Well, that steepening curve is fairly bullish on equities, and you see banks lead the way. So there's a lot of parts within, inflation coming out as well. So the energy market's been doing well. So there's a lot of components within the market that have been able to perform within this landscape. I do think that this bounce in yields lower in the prices is going to give a trading opportunity that, and we're looking to, out here, maybe it may not be this year, but may be more of the turn of the year to be able to buy treasury prices from a much lower level.
Mm-hmm. Some of the analysts I've spoken to in regards to gold have said that what gold really needs is real yields to come down. So if yields are staying flat or perhaps even rising from here, what we really need then is higher inflation, or at least inflation to outpace the growth of yields. Could that happen? I mean, inflation is ticking up, but it's not ticking up as fast as it maybe should in terms of what gold needs.
Exactly. And that's why we've called for silver and platinum to outperform gold this year. And I do think that, it's the 10-year is a great trade to have along with gold right now, if you're going to be hedging it. So I do think that, I do think inflation is, again, CPI was a little disappointing. We didn't get that inflation yet, but I think it is starting to show up, and you're going to see that be able to become a tailwind for gold, because the 10-year prices or 10-year yield has sort of front run that move in inflation.
Okay, let's talk about platinum then, because platinum has performed very well. In fact, it's the one metal I'm seeing on the screen that's green today. So why do you think platinum has, first of all, why do you think platinum has had this nice run up in the last month?
Well, there's definitely the fundamental side of platinum itself. There's been some closings of mines. You got obviously the pandemic that's still an issue, and that's curtailed some of the supply. So that's one tailwind there. But then you also have the inflation factor. Again, we're not seeing it in CPI numbers. We're not seeing a lot of the data, but you are seeing economic activity pick up. I mean, New York Empire State Manufacturing kind of got out of the gutter for the first time in months here on Monday or Tuesday, was it? And then Philly Fed has been fairly strong. You got a lot of activity being seen in the ISM numbers, services in manufacturing, really almost, considerably blowout reads on those. So the economic activities there, we're not really seeing it in inflation yet. So I think that's been a very big tailwind for platinum. It's been moving it. And really, this just technically, you're breaking out of a 10-year downtrend. And that's one of the things I've been calling for since the fourth quarter of last year is looking, when we're saying gold is going to be outpaced by silver and platinum. And platinum broke that downtrend. And our first upside target was 1,200, which we put a trade out there looking for 1,190 because there was good resistance from 1,200 to 12 and a quarter. It really got through that pretty good. And now you got a floor that's 1,200 to 12 and a quarter. And as long as it's out above there, I mean, we could see some big numbers here in platinum this year because we're really breaking that downtrend. And we've already seen a 13 handle.
Okay, so you think platinum is going to outperform gold and silver this year. What else is going to outperform, Bill? What else are you bullish on?
I'm very bullish on crude oil. I just, I don't like being bullish from these levels. I think that we've seen a very steep backwardation in crude oil. So meaning that April, which is the new front month contract, is about a $4.50 to $5 premium to say December. And I think that's going to come in a bit, and we may not see a full contango through the curve show up, immediately. But I do think that spread comes back in closer to $2 to $3. And in that case, crude would theoretically, the easiest way to get that spread to come in is see a little sell-off in crude. And I think there's a lot of resistance up near $62 that we've tagged. You got the energy crisis that's going on right now in through Texas. That's been another tailwind added. But Saudi Arabia also this week talked about some extra production coming online. But so I think that could weigh on the market. Once we get through the energy crisis, then the market digests extra production from Saudi Arabia. You got a little bit of higher prices that are good resistance. So we get crude to come in, and I mean, $53, $54 in the front month would be a terrific area. And then if you still got the premium relative to December, you're looking at December $50, I think is a great long. And I'm not saying this year, but given some of the things that we're seeing, some of the economic policies overall from the new White House, the inflation tailwinds, to all this stimulus slashing around, and then the vaccine rollout and increased demand in energy, listen, crude oil could get to $100 in the next 18 months. I would not be surprised because there's a big downtrend, and talking about similar to platinum breaking that decade-long downtrend. Energy, I mean, since 2008 has just been a big downtrend. We're right against breaking out of that downtrend right now.
Yeah, I'm just wondering, first of all, the backwardation you're talking about, usually when you see that pattern, what does that tell you about demand?
Well, right now the supply has been cut, so
Okay.
they've been able to to tighten that supply demand landscape in the recent months as Saudi Arabia cut off an extra million barrels per day in production. So right now the supply has been cut, and then you got a little bit of this economic activity starting to pick up. So you're right now the demand in the front month has been much higher. So you're seeing that prices really shoot up in the front month and outpacing those from the back month.
I'm just wondering, Bill, suppose oil does go up substantially. What does that mean for consumer spending? There's been a lot of talk about people going out to travel once the travel restrictions, the lockdowns end. But if oil goes up, if energy prices go up, wouldn't that damper demand for travel, cruise ships, airlines, all that kind of thing?
Yeah, but we don't have to worry about it right now. I say that facetiously, but
Yeah.
I mean, you see a reaction to one problem, say the pandemic, whether it be all the stimulus and then the cutting of production of crude oil. So you see reaction to one problem being the pandemic, and then overall down the road, it compounds to another issue, and that is going to be an issue. I mean, that really, I don't think it's an issue, over the next six to 12 months. But yeah, looking a year or two down the road, it definitely can become an issue. There's higher prices in energy hurting consumer spending, and listen, we go back to those days of 2010, 2009, 2008, where crude's up $2 or $3 one day or 1 week, and that's weighing on the stock market. That's not the other way around. Not where it becomes a tailwind.
Okay. Now, final question. Potential stock market crash. Could that happen this year because of rising yields?
Listen, I don't go out there and try and predict stock market crashes. That's not my job. My
Right.
job is to manage risk. I lay out on the advisor side as an asset manager, a diversified portfolio, and I do buy put spreads to hedge times, and I have some put spreads right now in there to hedge out some exposure in that portfolio just a little bit, and and then as well to have a diversification and getting things like dividend payments across the board, and then other sources that can perform, other asset classes that can perform when the market isn't. So, I mean, listen, am I fearful of a massive correction right now? No, I'm not. But I think a nice healthy 3 to 5% is very doable. And then when you talk about a 3 to 5% correction, I mean, listen, that could hit some triggers, some positioning triggers, and we could easily see another 5%. So, I mean, it's always possible, but I don't go through my day to day thinking here comes the massive correction right around the corner.
You're not going on Reddit and looking at the next meme stocks and putting your money in those. Is that part of a consideration as well?
No, it's not that's not my job. It's not what I look to do.
All right. Fantastic, Bill. Thank you so much for giving us your update, and we'll catch up with you again soon.
Thank you very much.
And thank you for watching Kitco News. I'm David Lin.